Welcome to the MLO SAFE Test Study Guide. Welcome. This presentation is designed to help you prepare for the MLO SAFE Test, a key exam for mortgage loan officers. We will walk through the essential topics, tips, and strategies to ensure you're well equipped to pass the exam with confidence. Whether you are new to the industry or looking to brush up on your knowledge, this guide will provide valuable insights and resources to help you succeed. Let's dive into the core concepts and important details of the MLO SAFE Test. Today, we're diving into some key federal mortgage-related laws and regulations, focusing on the Consumer Financial Protection Bureau, CFPB, and the Truth in Lending Act, TILA, which both play critical roles in protecting consumers in the mortgage market. The CFPB enforces several financial laws, including TILA, which was enacted in 1968 under Regulation Z. TILA ensures that lenders clearly disclose the terms and costs of credit in a standardized way, allowing consumers to make informed decisions and protecting them from predatory lending. When it comes to advertising, if a mortgage ad includes numbers, such as the down payment amount, repayment terms, or APR, it must disclose additional details. For example, if an ad mentions an adjustable rate, the lender must clarify that the APR may change. These advertisements must be kept for at least 2 years. As for required disclosure documents, the loan estimate, LE, must be kept for 3 years, and the closing disclosure, CD, must be kept for 5 years. For adjustable rate mortgages, lenders need to provide a charm booklet, and for home equity loans or refinancing, a booklet called When Your Home is on the Line is given. Also, the notice of right to rescind must be delivered within 3 days, and 2 copies must be provided. Next, let's talk about the APR, annual percentage rate, which includes the total interest and closing costs like lender fees, points, and insurance. Non-APR fees, however, include things like escrow for property taxes and insurance, appraisals, and title searches, which are still part of the overall cost but don't count toward the APR. If there are any changes to the loan terms, lenders must redisclose the updated terms. If the changes are greater than 1/8%, 0.125, for regular loans or more than 1/4%, 0.25, for non-traditional loans, they must provide a redisclosure. Failure to do so can result in penalties like a $5,000 fine or even 1 year in prison. Timing is very important in the loan process. The loan estimate must be sent either at the time of the application or within 3 business days after the application. As for the closing disclosure, it must be sent at least 3 business days before the loan is finalized, giving the borrower enough time to review everything. Let's define what a business day means here. It's any day that the creditor is open to the public, excluding Sundays and federal holidays. Now, let's talk about the Homeownership and Equity Protection Act, HOEPA, which was part of TILA and introduced in 1994. HOEPA was designed to protect consumers from predatory lending practices in high-cost loans. It applies to various types of loans, including purchase money loans, refinancing, closed-end home equity loans, and HELOCs, but it doesn't cover reverse mortgages or construction loans. To determine if a loan falls under HOEPA, you compare the APR to the average prime offer rate, APOR. For first lien loans under $50,000, the APR must be more than 6.5% above the APOR. For jumbo loans, it's 8.5%, and for second liens, it's also 8.5%. Additionally, if the points and fees are greater than 5%, the loan falls under HOEPA protections. HOEPA also imposes important restrictions. For example, borrowers must undergo counseling, and a full appraisal is required. There's a 3 business day cooling off period before consummation, and the law prohibits balloon payments, negative amortization, and repayment penalties. Refinances by the original creditor are only allowed after 1 year unless it's in the best interest of the consumer. Moving on, we have higher-priced mortgage loans, HPML, defined in Section 35 of TILA. The goal here is to protect consumers from high-interest loans by requiring stricter underwriting and escrow requirements. For HPMLs, the APR must be 1.5% higher than the APOR for first lien loans, 2.5% higher for jumbo first liens, and 3.5% higher for second liens. There are also restrictions on prepayment penalties, which are limited to the first 2 years, and an escrow account must be maintained for at least 5 years. A written appraisal is also required, and the lender must verify the borrower's income. They cannot rely solely on the property value. When it comes to appraisals for HPMLs, they must be completed by certified or licensed appraisers, and an interior inspection is required for first lien HPMLs. If the property has been flipped, meaning it was resold within 180 days, an additional appraisal is needed, especially if the price increase is significant. For example, if the price has increased by more than 10% within 90 days or more than 20% between 91 and 180 days, a new appraisal is required. That covers some of the key federal mortgage-related laws and regulations that play a huge role in protecting consumers and ensuring transparency in the lending process. The Dodd-Frank Act was signed into law on July 20, 2010, and made big changes to TILA and other financial regulations. It was designed to address issues that came up during the 2007 to 2008 financial crisis. The main goal of Dodd-Frank was to strengthen consumer protections. It expanded the protections already in place under TILA by requiring more comprehensive disclosures. It also introduced the loan estimate, LE, and closing disclosure, CD, forms as part of the TILA-RESPA integrated disclosure, TRID, rule. Dodd-Frank put limits on prepayment penalties. It banned them for adjustable-rate mortgages, ARMs, loans that don't meet the qualified mortgage, QM, definition, or high-priced loans. If there are prepayment penalties, they're limited to 3% in the first year, 2% in the second year, 1% in the third year. The penalty period is capped at 3 years. The ability to repay, ATR, rule requires lenders to make sure that borrowers can actually afford to pay back their loans before they approve them. Lenders have to consider things like the borrower's monthly mortgage payment, income, credit history, debt-to-income ratio, employment status, and other financial obligations. The Qualified Mortgage, QM, rule, introduced in 2014, gives lenders a safe harbor if they follow the ATR rule and avoid risky features like negative amortization, balloon payments, and interest-only loans. For a loan to be a QM, it has to meet some key requirements. Points and fees can't exceed 3%. The back-end debt-to-income ratio, DTI, must be below 43%. Prepayment penalties are limited to 3 years. The loan has to be fully amortized, with a maximum term of 30 years. The APR must be lower than the average prime offer rate, APOR, plus 2.25% for first liens or 3.5% for second liens. Loan originators can't be paid based on the terms or conditions of a mortgage. This rule helps avoid conflicts of interest and ensures that the originator isn't pushing certain loan features just to increase their compensation. The anti-steering rule prevents lenders from directing borrowers to specific loan products to increase their own compensation, especially when it's not in the borrower's best interest. This ensures that borrowers are getting the loan that's best for them, not just the one that benefits the lender. Dodd-Frank also requires lenders to keep at least 5% of the credit risk when they securitize loans. This helps reduce risky lending practices. However, loans that are insured by government agencies, like FHA or VA loans, are exempt from this requirement. Also, certain qualified residential mortgages, QRMs, which are considered lower-risk loans, are also exempt. Congratulations on taking the next step toward becoming a certified mortgage loan officer. We hope this study guide has provided clarity and a solid foundation for your exam preparation. Remember, success comes with dedication and practice. Stay focused, keep reviewing, and you'll be well on your way to passing the MLO SAFE Test. Good luck with your studies, and feel free to reach out if you have any further questions or need additional resources. Stay confident, and you've got this.